Welcome back, everyone. Today, we are looking at something that honestly unites almost every single event happening across the globe right now. Whether you're kicking back on a wooden porch in a rural town or you're staring at a blinking, high stress terminal on a trading floor, you are likely experiencing it. We're talking about the anticipation economy. We're going to see how the universal human experience of waiting, of just anticipating what comes next, connects today's incredibly eclectic global events, from major cultural milestones all the way to high stakes macroeconomic policy. Okay, let's dive into this. Here is the roadmap for today's explainer. 1. The art of anticipation. 2. Jobs data versus interest rates. 3. Current market reactions. And 4. Politics, sports, and celebrations. I promise you there is a totally logical, fascinating path connecting a tranquil rural village to the absolute highest levels of the Federal Reserve.
So let's start with section 1, the art of anticipation.
Okay, I want you to just picture the scene for a second. A nostalgic Indian village at night, centered around a traditional farmer's store. You've got these warm yellow bulbs softly flickering against the cool blue moonlight. Inside, seed packets and farming tools line the shelves, while a slow-turning ceiling fan pushes the humid air around. Outside, on a little wooden platform, kids are sitting together, swinging their legs, laughing, sharing stories after dinner. You've got fireflies drifting around the trees, a faint mist rolling across the fields, and way off on the horizon, a distant passenger train is slowly crossing with these softly glowing windows. It's this timeless, cozy feeling. It's calm anticipation. They're just waiting for the train to pass, waiting for tomorrow, just existing peacefully in the moment. It kind of makes you miss those simple village nights, right? But what's really interesting is the stark contrast to what's happening on the other side of the world. While those kids represent peaceful anticipation, the exact opposite is unfolding right now on Wall Street. It is a hard pivot from cozy nostalgia to high anxiety reality. Right now, global markets are stuck in an incredibly tense waiting game, basically bracing themselves for the June U.S. employment report. The core feeling is the exact same, anticipation. But man, the stakes and the stress levels literally couldn't be more different.
Which brings us to section 2, jobs data versus interest rates.
So this brings up the million-dollar question. Actually, scratch that. It's more like a trillion-dollar question. Why exactly does Wall Street care so much about this jobs report? Why does a single piece of employment data cause seasoned traders to hold their breath and markets to completely stall out? To really get this, we have to look at the primary goal of the central bank right now. And that goal is defined by this one metric, the 2% target. Federal Reserve Chair Kevin Warsh has been crystal clear. He has firmly reiterated that the central bank remains absolutely committed to controlling inflation and keeping it right at the specific 2% benchmark. Look, despite any outside political pressure for lower interest rates, Warsh is not signaling any immediate rate cuts whatsoever. He is maintaining a strictly data-driven approach. That means every single move the Fed makes is going to be dictated by incoming economic data. And that makes the upcoming jobs report the ultimate catalyst for what happens next. To put that into perspective, economists are predicting moderate job growth right now, with expectations for the June U.S. unemployment rate hovering right around that 4.3 to 4.4% mark. Investors are nervously eyeing these figures because if the actual numbers come in surprisingly above or below these expectations, it triggers a massive ripple effect across the entire economy. Let's break down how jobs data actually influences interest rates. It's a very mechanical cause and effect. If we get a stronger than expected jobs report, that means more people are working and spending money. Great for regular folks, right? But for the Fed, that increases inflation risk. To fight that inflation, they are forced to keep interest rates higher for longer to cool down all that spending. Conversely, if the jobs data is weaker than expected, the economy is already cooling off on its own. That reduces inflation fears and actually boosts Wall Street's hopes for rate cuts. So ironically, good news for the job market is very often bad news for the stock market. Those employment figures literally dictate the cost of borrowing money for everyone.
Let's move on to section 3, current market reactions.
You can literally see this anticipation leading to highly cautious trading as we speak. In the previous session, the Dow Jones closed virtually flat at 52,305. The S&P 500 slipped just a tiny bit, down 0.22% to 7,483. But the Nasdaq Composite took a much bigger hit, falling 0.66% to 26,040. Why the drop in the Nasdaq? Well, it's largely due to heavy selling and profit-taking in the tech and semiconductor sectors after a super strong recent rally. Investors are playing it safe. They are taking their chips off the table before the jobs data drops. But within that whole tech sell-off, There are some pretty fascinating exceptions. While chip makers were among the biggest losers as investors locked in their profits, Meta platforms actually gained sharply. Why? Well, reports surfaced that Meta plans to aggressively expand its AI cloud business, and that burst of optimism was enough to help limit the broader market losses. It really goes to show that even in a highly cautious environment, major artificial intelligence developments can still drive massive buying power.
Meanwhile, pivoting over to commodities for a second, we really need to look at this crucial number, $70. Crude oil prices have eased down to around $70 per barrel.
And this builds a really interesting broader picture of global commodities right now. Oil dropped to that $70 mark mainly due to growing optimism surrounding indirect US-Iran diplomatic talks in Doha, which is basically stabilizing everyone's expectations for global supply. But in sharp contrast, gold is actually edging higher. While oil is responding to diplomatic progress, gold is responding directly to that nervous macroeconomic anticipation we've been talking about. Investors are seeking out gold as a traditional safe haven asset while they anxiously wait for the Fed's next move.
Finally, Section 4, politics, sports, and celebrations.
Just look at how much the world is buzzing beyond the financial markets right now. In sports, fans are eagerly anticipating the next big match after the U.S. men's national team defeated Bosnia 2-0, officially advancing to face Belgium in the World Cup round of 16. Culturally, America is gearing up for a massive milestone. Lawmakers are gathering in Philadelphia to kick off events commemorating the nation's 250th anniversary. At the same time, over in Washington, routine political developments continue as lawmakers scrutinize administration policies on cryptocurrency financial disclosures and immigration enforcement, just preparing for upcoming legislative shifts. And on a purely practical level, millions of Americans are currently packing their bags, embracing for one of the absolute busiest Independence Day holiday travel weekends of the entire year.
So it really is an incredible spectrum of waiting, isn't it? Whether you're a child waiting for a train to pass in a moonlit village, an investor holding your breath for a 4.4% unemployment print just to guess how the jobs data will influence the Federal Reserve's interest rates, a sports fan waiting for a World Cup kickoff, or a traveler sitting in brutal holiday traffic. Anticipation is basically the engine of the present moment. So I'll leave you with this question to chew on. From those peaceful rural village nights to Wall Street's anxious data watch, what are you anticipating next in this crazy, dynamic global landscape? Keep a close eye on those jobs numbers, and we'll see you in the next explainer.